Okay, welcome to 2026 and welcome to season two of First Draft Live. I'm Mark Bonner, Business Editor in Chief, coming to you live from New York. Before we get started, I'm proud to say this episode of First Draft Live is presented by Agora. Whether you're managing deals, raising capital, or growing your portfolio, Agora is your trusted platform for seamless real estate investment management. Visit agorareal.com to learn more. That's Agora real.com. Okay, let's talk about the moment we're actually in today. If you work in commercial real estate, I think you know this feeling. You go to bed thinking you understand the market, and you wake up to a late night social media post out of the White House that just rewrote the risk conversation. Tariffs, they're back in the bloodstream. Venezuela, now in the energy conversation. Greenland has now somehow become a trade and geopolitical variable. And the Federal Reserve, the institution markets usually treat as untouchable, is under immense political pressure. And in the last day or so, it has come out that the U.S. is actively seeking regime change in Cuba. And that's just the headlines. Let's layer on what the industry itself is quietly also wrestling with. AI demand that looks transformational, but is now being stress tested for durability. Power and grid constraints colliding with data center optimism. Insurance and operating costs that refuse to normalize. Refinance optionality shrinking, and exit liquidity getting harder to underwrite. And capital that's available, but no longer forgiving. On paper, that feels like the setup that could trigger panic. But it hasn't. Far from it, in fact. Deals are happening. Capital is moving. Office, trading, multifamily, trading, data centers, definitely trading. What's changed isn't activity, it's judgment. Underwriting is tighter, holds are longer, structure is doing the work, and conviction has narrowed. Which brings us to the real question of this moment. When all of that hits the market at once, tariffs, geopolitics, AI hype, power constraints, and questions around Fed independence, how does commercial real estate actually respond? Do investment committees cut leverage, pull refinance risk forward, widen exit assumptions, or do they just pause, close the deck, and wait for the noise to pass? That's the conversation we're going to have today, because the real story of 2026 isn't going to play out on social media or cable news. It's going to play out inside investment committees. Few people that I know sit closer to that process than our guest today. Joining me is Abbe Borok, Managing Director and Head of U.S. Debt at BGO, someone who sees exactly, intimately, how macro uncertainty turns into term sheet math. Abbe, welcome to First Draft Live.
Thanks for having me, Mark.
Real quick before we begin, to our audience, drop your questions and comments into the chat. We'll get to as many as we can. So, Abbe, thanks for being here. Before we get into the mechanics, just level with us for a second. You've been doing this a really long time. Have you ever seen this many variables hit the market at once without tipping it into panic?
Yeah, well, I have to say that was a great intro, and I'm actually going to make sure my team listens to that intro, Mark, because I don't want to make sure we're not forgetting any of the risks that are out there right now, because there sure are a lot of them, and everything's moving so quickly. So, but to your question, I would say, it is a lot right now. There are a lot of different variables. I think the rapidity with which everything's changing, with which the headlines are changing, with which new macro factors, whether they're policy or macroeconomic, are changing, and we're hearing those are that's, I don't know if I'd say overwhelming, but it's a lot coming at us. Part of that is just the technological advances that we've had as well, because we're getting a lot of that information in real time. So I do think, as we start to talk about the investment process and how we're approaching that, I think one of the challenges is sometimes filtering out some of that noise and making sure that we're really dialing back into the fundamentals, what we as a team know about real estate, reminding ourselves that we have been through disruption like this. I cut my teeth in the GFC, so that was probably went to answer your question. Probably, the last time we saw this disruption in the commercial real estate markets. But there are a lot more variables, I would argue, coming into this, most recent cycle that we've had.
I mean, the GFC is an interesting example, Abby. I mean, is that really the historical parallel that's actually useful right now? I mean, I remember the GFC. It was complicated, it was painful. It didn't feel as broad and multifaceted in terms of the variables. It seemed very clear to me. So is that the right parallel here? Do we all go back to the GFC playbook, or is there some other moment in history that could be a more useful guide?
Yeah, no, I would say I think that's the most recent and best data point for the commercial real estate market and just the pressures on valuations and overall market and pause in activity that we've seen over this most recent cycle. In terms of just the variables, there's a lot of additional information that's coming now into the market. But yeah, I think that, as we look back, I don't think we're playing out the same playbook to your answer. I think that there's
Hmm.
definitely a different approach to some of the downturn that we've seen in the commercial real estate market that we're starting to, come out of, I would argue. But that's certainly a data point that we think of as we say, and again, I've been a lender my whole career, so it's all about the downside and the stress analysis. But how and the question of how bad can it get, and we're still going to get our money back on every loan, and that's a data point that we look to often. It's interesting. There are a lot of professionals in commercial real estate today that probably hadn't lived through that. So this is their first correction. So kind of pointing to that, and then also getting input from those who lived through, similar real estate crises going back even further. So I think, allowing that historical experience and maybe not the exact same playbook, but, some of that experience that we've all had and making sure that we're kind of communicating that out to our teams as we've faced this most recent correction, we found to be helpful.
For a lot of people, as you just said, this is their first rodeo, right? And so a great place we can start with that is tariffs, right? Tariff risk has come roaring back into the market. We dealt with it for much of last year. Now it's back. We're talking about renewed threats and actions around imported steel, electrical components, building systems, the kind of inputs that sit at the heart of construction and heavy value add deals. The issue, as we've reported at BizNow, isn't higher costs necessarily. It's unpredictability. Sponsors can't lock budgets the way they used to. And ICs are struggling to model downside scenarios if tariffs shift again mid-project, which they are shifting right now. We'll see. Taco is sort of happening here with Greenland. What I'm seeing, Abby, and I'd love you to take me into the room, I'm seeing that deals aren't blowing up, but they're slowing, especially construction and heavy value add, because committees can't get comfortable with cost volatility. At least that's my perception from the outside looking in. Take me inside the room. When these tariffs re-enter the conversation, what's the first lever that IC is pulling on your end?
Yeah, I mean, 2025 is really, you can kind of go back a year and look at what transpired over the following 12 months. The first quarter of last year saw a lot of transaction volume. There was definitely a return in activity to the market, and that quickly shifted, particularly in the real estate equity markets, with Liberation Day and with a lot of the trade policy that was rolled out very quickly or was threatened, and then was the uncertainty that came along with that in April. So, last year, I think there really was a more of a normalized return to debt capital in the markets.
Hmm.
We saw that, across our portfolio, our ability to underwrite deals and feel comfortable at our attachment point, comfortable that, while there were a lot of these concerns, which we can dig into and talk about felt like the market had bottomed, and we were able to attach to new reset values. So that, was a positive. I would say 2025 was a positive for real estate debt capital in the markets. But the equity markets have trailed that. So we saw a real pause, to your point. I think as everyone got their arms around some of the trends that would come out, which areas of the market would benefit from the trade policy, which areas of the market were not going to benefit. I don't think anyone has a crystal ball, but there were ways for us through our data and analytics and through our analysis of the policy decisions to kind of begin to pick our spots. And activity on the equity side's really picked up towards the end of the year and now into 2026. That being
I
said,
mean,
activity is one thing. I think there's still a lot of idiosyncratic considerations that are coming into what deals we actually do. So I wouldn't necessarily say that right now activity is completely correlating with deals getting done. But we definitely feel that this year going forward, there's a lot of, frankly, despite a lot of the noise that we've been hearing, we can also point to data that shows that there's real, that we're beginning to see some tailwinds for certain segments of the commercial real estate market.
right. And so let's get into that. This is project by project. There's no automatic yeses or nos. What projects are feeling this the most right now? Ground up, major renovations, adaptive reuse.
Yeah, again, transaction activity coming back to the market, really and again, for our value add lending business is really a tailwind. So groups out in the market that are buying assets, many times at reset bases, putting new cash equity in, that's helpful, where we have seen valuations correct in some of the open-ended funds and, in valuations in existing portfolios, but begin to see real market trades on the ground that we can point to is also very important. We are one of the larger owners of industrial, BGO is, across the US. We have about 138 million square feet. So we obviously tracking that market very closely. We see a lot of positives as we go forward. That market has bottomed. We're seeing deregulation that makes it easier for companies to make decisions on where they're going to spend money, what kind of leases they're going to sign. We obviously are in a lower to more stabilized interest rate environment. So, I think a lot of us real
Well,
estate.
we'll get into the Fed in a second. I
Yeah,
don't
we
know how
get on these
stable that
panels at the
is.
beginning of the year, and everyone asks you where are interest rates going to be at the end of 2026, and it's a little bit of a funny question. But rates have come in. We think they will continue to moderate and stabilize. Inflation is stabilizing as well. We still have some noise there, but there has been stabilization, and productivity is solid. So. So for certain asset classes, industrial, there are also subsections of industrial where we really have been focusing on our debt business. We've been active in manufacturing industrial. So where we've seen this reshoring from the tariffs and the trade, we think that will continue. Advanced manufacturing, some of the policies that have put in place are definitely turbocharging the ability for advanced manufacturing chips and other digital infrastructure that that is coming back to the US. So definitely pockets within the industrial asset class where we're seeing interesting opportunities. I'll go to the next asset class we all talk about, multifamily. I mean, there continue to be interesting opportunities there. That market the debt markets for multifamily have come back. That we, are seeing, we had some supply issues there in certain markets, but beginning to see that normalize, and definitely continue to see that supply demand imbalance persist on an ongoing basis. So, again, industrial, multifamily, I'd say for the other main food groups, we just signed up our first retail deal in a while. So I think, retail has been one of the highest performers over the last 2 years for commercial real estate. So definitely after many years of almost being uninvestable in certain ways, we're seeing that come back, and finding opportunities there. And then office, I'm sure we'll get to that, beginning to see some normalization, but still a lot of pockets
But
of.
Abby, just in one sentence, right? What are sponsors consistently underestimating right now when they pitch these deals, and specifically on the tariff fall line?
Um, on the tariff fall line. So I don't know if it's consistently underestimating, but consistently up against, um, you know, construction costs and debt costs. And again, I think if you look now versus 12 to 24 months ago, I'd argue those have moderated, but those continue to be, it's very expensive to build. And those
Yeah.
continue to be headwinds for our business and for our borrower sponsors.
I mean, working a pro forma right now on the construction side is a nightmare. And I've spoken to many heads of construction over the last 6 months. And so it's definitely unpredictable. Contingency budgets have exploded. I mean, it's very difficult to predict and all sorts of other things that are happening in the construction industry. But
Yeah.
we got to move on. Let's talk
Lender.
about Venezuela.
I'm always about, yeah, we can lift that contingency a little bit more and let's make sure that we're, adding in some cushion. That being said, it makes, when debt levels were as high as they were and construction costs had increased, it created real an inability in many cases to develop. So we're beginning to see that moderate, particularly on the debt cost side. For the construction loans where we are lending right now, we really love that pro forma because we look out 3 to 4 years from now, and just the supply dynamics in many of these markets have completely shifted. So if you look at 24 and you look at the deliveries that came into place, deliveries that came to be in the market, that's just going to be dramatically reduced over 3 to 4 years out.
Okay, we got to move on. Let's talk about Venezuela. Obviously, we all know the U.S. took out Maduro, seized
Yeah.
Venezuelan linked oil tankers, and stepped up enforcement around oil flows and sanctions. That doesn't mean oil prices spiked overnight, but it does mean energy volatility is back on the risk radar in a way it hasn't been for years. I would imagine, Abby, that inside the IC, no one says Venezuela. I would imagine that they say volatility assumptions matter again. We're seeing lenders quietly re-underwrite tenant durability, especially in logistics, manufacturing, and energy-sensitive consumer businesses. Not because tenants are failing today, but because volatility is back in the model. So, inside the investment committee, how are you seeing these geopolitics actually translate into the underwriting? Is it in exit caps, proceeds? Is it tenant assumptions? Did Venezuela rock the boat for you guys a few weeks ago?
Yeah, no, I mean, I'll be really honest. I don't think Venezuela as a word has, been a frequent discussion topic. I think yes, volatility and the macro environment and some of the, whether it's Venezuela or Greenland or some of the just very disruptive actions that have been taken for good or for bad on the global stage over the last few months. That definitely creates more volatility. So I would say what risk is not being debated in our investment committee. So in those increases, it's really drilling into the details. Does that to answer your question, how is that coming to bear? It can be all of the above, not at the same time, but it really is dependent on the deal. Is it a market or does it have a tenant that does have that exposure either to their supply chain because they are dependent on energy prices? Is it a certain market like not to call out markets, but the Inland Empire has a lot of softness. Is that due to trade and our relationship with China? How does that price into tenant demand and underwriting? And it'll include some. If we really think that rents are stagnating there or continuing to be soft in the long term, that probably does reflect cap rates. That being said, we also, on the counter side in the US, have the ability to look at cap rates and say they've really begun to stabilize in certain markets. So it's very much a market by market. That's where we at BGO are using our data and analytics. We're force ranking the 300 plus markets in the US where we're active, and really, and again, the data that we're using is not just one, you know, I would argue it's not even kind of the historical data we all used on real estate, but really bringing in a lot of different data sources surrounding supply, and a lot of that comes from some of these macro, whether it's the supply chain
Right.
or tariff policy, and then on the demand side, it's a lot of, I think that's probably to your earlier question about where things are so different right now in real estate than if you look back 10, 20 years. I think the demand question is probably, it used to be, supply demand. And when there was too much supply, then you were going to have some softness in the market. I think there are a lot of changes in just demand and consumer usage of real estate, and those probably necessitate a different data source. So we're spending a lot of time saying what is really driving tenant demand for logistics, or office is a good example, where how do we get people back for work from home? Why? What is it about New York and some of the office buildings
Yeah.
here that's really been able to draw people back, and why are other markets like a Denver really lagging? So all of those data points come together specifically on a deal, and every deal, it's do we, is there a reason to get more aggressive and price that more? Do we have conviction around that market because of our data and analytics and because of our teams on the ground? Or do we think some of these bigger macro issues are going to continue to persist? And then we will be looking at, um, you know, delevering or putting more structure in our loans.
Okay, if you're just tuning in, this is First Draft Live, presented by Agora. We're here with Abbe Borok, Managing Director and Head of U.S. Debt at BGO. Now, Abbe, something that's interesting with this Greenland noise that we've been seeing the last couple of days is that the drumbeat of negativity from Europe and other foreign capital that might otherwise flow freely into the United States is in question. Now, there isn't any data so far that that sentiment is going to become reality, but the voices from Europe and other parts of the world are now saying the US can't be trusted. You guys are too unpredictable. We'd rather flow our capital into Europe or Asia or to Africa, or to Oceania. What do you make of that? Have you seen anything on your end to believe that that's real and that's going to come to bear fruit in the U.S. market?
I mean, anecdotally, yes, I think there are Canadians and Europeans that look to the US and are not, don't feel good about some of the actions that have been being taken. But the U.S. continues to be one of the most liquid and the most active market in the world. So to say that there's been, that's going to translate to sustained lack of investment in the U.S. I think we again see a lot of, as we come out of this most recent correction, out of this period of time where there's been such a dearth of transaction activity. We continue to see that picking up as we go forward. But certainly, we have a very large European debt business as well. There's really compelling opportunities in Europe right now, partly because just some of their dislocation and the growth of alternative lenders in Europe. We've seen that in the US over the last 10 years. It hadn't, while we're a very large player there, it hadn't been as robust in Europe. So many more markets we can invest in
Right.
there. And I do think, just personally, there will be instances, where because of some of the policies here in the US, whether it's, foreigners selecting which universities they go to, and whether or not European universities continue to grow in enrollment, and niche asset classes like student housing there maybe become more interesting to invest in because of those demand drivers. I think we're definitely going to see different ways in which that plays out. But again, And certainly you can see it on some of the shelves, I think, for our
Yeah.
northern neighbor. Some of the policies and the rhetoric
You know,
has
when I wonder about this, I don't really wonder about the multinational global players who can pivot into one region or the other, right? What I think about is the grand majority of commercial real estate players in the United States are US based and they're only in the United States. And so they cannot pivot into Europe or to Asia or in any other places. Like if Abby, I mean, put yourself in the shoes of someone who's just a local player or regional player or even a national player just in the United States. Like, would that be a threat of sorts to take seriously? Or do you think most of them are just saying that's just noise and it'll pass because the US is safe? We are the biggest and the strongest economy the world has ever seen. It is the biggest, most powerful commercial real estate market on the planet. And therefore, despite the noise, much of it emanating out of the White House, that the market will survive and will even, in fact, thrive past all of this noise and all of these different variables that it's encountering.
Yeah, I mean that I would argue that that's the case for the US. I think I think the period where we're entering now, if you compare that to kind of the pre-COVID period, there's a lot more that needs to be done on the ground. It's a lot more about income generation and making sure that you can push rents and the executing on the business plan on the ground versus cap rates are so low and interest rates are so low, you kind of can make money on a buy just given some of the financial engineering. So I think you know the the boots on the ground, the business plan, the really what the underwriting of that real estate business plan, that is what we're talking about usually in investment committee, is even more important. So we are spending more time on let's look at budgets, let's look at timelines, let's look at our partner or borrower's track record and their ability to execute and make sure that it's a more of kind of an asset specific and business plan specific analysis, I would argue, um,
Hmm.
that's coming out of a lot of this volatility.
Okay. I'm sure you know that we have a Fed meeting next week. Um, and the Federal Reserve, the central bank, has itself now become a variable all over again between political pressure, legal scrutiny, open questions about independence. The market isn't panicking. It's saying a lot of things, but the market is doing what it does, right? I would imagine, Abby, that ICs are no longer underwriting a clean, predictable rate path. It's anyone's guess what Powell's going to do next week. We can go on Kalshi and Polymarket and we can read the breeze that's blowing there, but we don't really know. I would assume that the biggest change is in pricing today. It's refinance assumptions for tomorrow. When confidence in the rate path weakens, what changes first over in your shop? Loan term, extension test, exit assumptions? What do you think is going to happen next week?
Yeah, no, the short answer is we're always kind of stressing those assumptions, right? Because we want to make sure that scenario testing is being done at a very granular level to make sure that to the best of our abilities, understand the exit scenario, that next buyer analysis. So that's a super important component. I'd say though, basis matters also. Like everything is about where we are on a basis level. What are replacement costs in that market, and how does an existing asset compare to that? So a lot of it is also driven by just our, having been through many of these cycles, having that uncertainty around interest rates. I think the assumption is interest rates are definitely going to be more around this long-term interest rates around this 4% for a longer period of time. So I think that's what we're assuming. A lot of our loans, we are mitigating some of that interest rate risk, which doesn't necessarily affect the valuations, but allows us to kind of, with floors and interest rate caps, kind of mitigate some of that risk. But I think that's a long answer, Mark, of telling you I don't know what's going to happen next week.
Okay, we're running out of time here, but I want to do a little speed round here because I think for a lot of people, what happens in the investment committee is mysterious. So help us to understand what actually happens here, Abby, really quickly. How do ICs actually say no? What's the most common reason a deal quietly doesn't clear?
It's a credit reason for on the debt side, and it's an underwriting reason. It's that there's not the level of data and market support for underwriting the levels that we would need to underwrite for that to be a good deal. So it's a credit issue.
Okay. Does IC protect itself more by changing structure or cutting price?
Structure.
And when committees debate
Structure is
exit
so
cap,
important. I mean, that's
yeah,
top of having a structure in place that allows you, most real estate deals, something changes after you close it. Many times it's to the good.
yeah.
Sometimes it takes longer, or there's some of these types of unknowns that we've been talking about for the last half an hour. Structure is really where the rubber hits the road there.
So when committee debates exit caps, are they arguing about the number or about timing and liquidity?
Both.
Okay. And what misconception about the refinance window is getting sponsors' haircut most often right now?
Misconception about the takeout market. I think for us, we're very focused on, to my point earlier, that we had a long period of very low cap rates and very low interest rates. So making sure we're really stressing those appropriately, which for some of the younger folks can be painful, but really making sure we understand what the long-term historical averages were and incorporating that into our analysis.
How do you feel about the year before you right now? Last question.
I feel optimistic. I wanted to say cautiously optimistic, hedge my bets, so to speak. I am a lender, but I optimistic. I mean, I think we will. I think investors will continue to tread lightly, but I think that there's an ability to pinpoint many of the economic data. Uh, the economic data that's coming out and saying that, again, for commercial real estate, we have bottomed out in most markets and most asset classes, and there's an ability, and we didn't even get to data centers, so that's a whole nother
You'll have to
component.
come on next time.
But yeah, we're excited about what we're doing at BGO, where we're spending our time with clients and investing in the markets, and hope that that continues. But are prepared
Okay.
if it doesn't.
Okay. That's all the time we have today. Abby, thank you so much for being here. We really appreciate your insight.
Awesome. Thanks for having me, Mark. Have a good weekend.
You too. And a big thank you to Agora for presenting this episode of First Draft Live. We'll be back soon with another episode, so don't miss it. You can sign up now on our event page. You can also find today's episode and all of our past conversations on your favorite podcast app. This is First Draft Live. Have a great weekend, y'all.